So my name is Ashton Marcoux. I am the Senior Manager of Wealth with Rapport Credit Union. And it is my pleasure to be able to introduce you to Michael Trickla. He will be presenting today the building blocks of retirement. So Michael is a Senior Wealth Advisor with Rapport Credit Union. He has a 30-year track record of helping clients make smart decisions about their money. He is a certified financial planner and a fellow of the Canadian Securities Institute. In the past 30 years, he has guided clients at all stages of their lives to navigate through their unique planning challenges involving investments, taxation, risk management, and retirement, to name a few. Working with clients at several of the Canadian major banks, Michael has also worked as an advisor with the Ontario Pension Board and has helped many employees of the OPS with their financial planning and early retirement decisions, with their pension plan as the cornerstone of their retirement portfolios. Michael has lectured across Canada and has written several articles on investing and financial planning, as well as been chosen as the Wealth Professional magazine as one of the top 50 advisors in Canada in 2014. Michael also lectures part-time at the School of Business Financial Planning program. Michael lives in Milton with his wife and teenage son and has a passion for woodworking and fitness. So thank you all for joining us, and I'll hand it over to Michael.
Thank you, Ashton, and thank you everybody for attending. Great, we're very excited to be here today, and I know we're going to be able to provide a lot of good information for you. So it's a fairly informative session. What we will do, though, is you may have some additional questions throughout the presentation. I'm just going to request that we hold the questions till the end of the presentation. That way, we'll make sure we get all the information that we want to deliver in for you guys today. And so on that, let's get started. So what we're going to talk about today is essentially the building blocks of retirement. And for members of the OPS, that's there's some nuances that have to be taken into account that really, although they're in common with a lot of individuals within the pension organization themselves, what will happen is, in many cases, we have to take into account the pension plan itself. So we have a couple of goals today, and there's basically 5 learning objectives, and really these are universal for anybody who's retiring. So we want to certainly look at defining one's retirement needs. Everybody has different needs in retirement, so certainly we want to look at that and address that. We also want to, you also should get an understanding of your pension and your government benefits, because these, for most of you, will be the cornerstone and the largest amount that'll contribute to your retirement income. For many of you, you'll have savings and investments also that you've been doing throughout your lives during your working years, and you want to know how that's going to fit into your pension as well, and your retirement income needs. You also want to learn how to minimize tax. As a financial an accountant once used to work with many years ago, he says it's not so much how much you make as how much you keep in your jeans at the end of the day. And minimizing tax and some strategies around that are some important things that we want to look at. And the last thing is where you can look for more information, because retirement planning and financial planning are kind of ongoing exercises, and there'll be different changes in your life, and there'll be places where you want to kind of clear things up. So we're going to provide some sources for that as well. So the first part is really, let's start with where you are right now. The reality is, for everybody out there, is we all have expenses. We have different expenses that go on throughout one's life, and certainly we want to look at those as well. So for the example is here, let's look at household expenses. Okay, these are essentially the expenses that we look like. These are utilities, the cost of running and maintaining your home. And these are likely to continue throughout your retirement. Not too many of these are really going to be changing all that much. Maybe as you get older and your kids get older rather, And if you have kids living with you right now, some of these might decrease incrementally if once they go out on their own, but really they're not going to change all that much. The second is the discretionary expenses that you'll be looking at. So this is like personal spending, things involving dining out, gifts, vacation, travel, hobbies, sports, that sort of thing. These are kind of the things that kind of round out our lives and make life more interesting, and the like. And these are variable expenses. These kind of come and go. Sometimes they go seasonally. Sometimes they go. We're different stages where we are in life, but these are all variable expenses, and these can, as the name suggests, these can change. And finally, there's the non-discretionary expenses. These are the ones that really are kind of set in stone, that what you have to pay throughout if you incur any of these. So obviously income tax is one of them. Debt payments may change. You may pay off debt or have no debt. So that may change. You may increase your savings or stop your savings if it need be. Pension contributions, once you stop working, obviously you won't be contributing to a pension plan anymore. And if you are fully retired, you won't be contributing to CPP, so the contribution stat will stop. And also once you stop working, EI contributions end as well. So there's a lot of different expenses that change. But the thing is, one has to look at is, how do they affect you? So let's look at a typical OPS employee while they're working, and we just chose some numbers here at random, but something more of the middle of the road thing. So let's say a typical OPS employee, while they're working, they're generating an income of about $75,000. And let's say they're looking at a retirement. At retirement, their pension is going to pay them approximately about $37,500. So it's about half of their gross salary. Now, while they're working, they'll have some expenses. They're going to be contributing to the pension plan itself. So whether you're a member of OP Trust or OPB or OMERS for that matter, you're going to be contributing to this plan as well. While you're working, everybody who works in Canada also has to contribute to the Canada Pension Plan. So for an employee of this income level, they'll be contributing about just over $3,000 a year. You also have to contribute to employment insurance as well. So we'll look at, there's some contributions there. And if you're a member of a union, you'll have to be paying the union dues as well. So your total income after all these deductions is going to be about $65,500, and you're going to pay about $12,695. So your net income is going to be $52,802. And you're saying, well, you know what? That's what I'm living off of right now, but my pension is gross pension is only $37,500. So that could be pretty scary for a lot of people. But let's look at this a little. Let's kind of dig down more deeply and look at it further. So if we look at it more deeply, you're going to see some expenses that you're not going to have anymore. As we mentioned in the a couple slides back, you're not going to, once you retire, you're not going to be making contributions to your pension, nor you'll be contributing to CPP, EI, or paying union dues. So that's about $9,500 a year that you're no longer paying into, that's being deducted off of your income. So you're really looking at a net income that's significantly closer to that $37,500 that we looked at. So again, these are things that we have to look at. So when we're looking at retirement, we're looking at income and retirement. Where's that income going to come from? For the most of us, for the most of you on the call today, your largest piece is going to be from your employment pension. And then you're going to have some also from the CPP and from the old age security. So if you look at the three largest wedges of that pie, those are essentially guaranteed income sources. And when I say guaranteed income sources, they're going to be essentially that. As long as the federal and provincial governments are around, and as long as they can still tax us, you will still get your income. And so those are sources of income. The variable in all of that is your savings, and that's the part that for some of us will finance some of those discretionary expenses that we talked about earlier on, those vacations, the trips, dinners, gifts, and that sort of thing. So let's look a little bit further at the largest wedge of your retirement savings there right now is your defined benefit pension. Now, you've probably heard this term defined benefit pension. What it essentially means, it's a pension plan where your benefits are defined. And it's based on a formula based on your average salary for the last 5 years of your employment, as well as the number of years service that you've had within the OPS. Most pension plans in Canada right now are defined contribution, which are based on how much you've contributed to the plan and what the plan is worth at the end. This is more formula based. So a couple of the features of defined benefit plans, unfortunately, they're taxable, just as all sources of income are in Canada. But on the upside is that they're guaranteed income for life. So as I said, as long as the provincial government is around and the pension plan is funded, there's no concern about the plan running out of money or you not getting your pension income. The pension plans have done fairly well. The government pension plans and the funding is done fairly well. So really, this is the income is not at jeopardy for any of us on the call today. They may include inflation protection. If you're a member of the OP Trust Plan or the OPV plan, those plans are adjusted and your payments are adjusted on an annual basis based on the inflation rate. Now, they both have a maximum inflation rate of 8%. So they will adjust the payments on your pension, your monthly payments or your annual payments by 8% or whatever the inflation rate is, up to 8%. If the inflation rate goes above 8%, they just carry that excess over to the following year. So really, you will maintain your purchasing power while being part of the OPB or the OP Trust pension plan. Some of the other pension plans that are available out there, the defined benefit ones, they aren't fully indexed to inflation. Some of them are indexed at lower percentages. As with all defined benefit plans, you as employees have no control over the investments of the plan. The plan is run by a professional investment team. They pick the investments within the plan and they also manage the risk. And as I said, because it's a defined benefit plan, you're guaranteed to get your benefits. So there's less risk to the employee in regard to whether you're managing funds yourself. So when we look at pension plans, there's a concept that comes out there. And really, we always, when I was at the Ontario Pension Board, and really lots of times throughout my career and now at Rapport, I get questions about CPP integration. And what does it mean and how does it work and the like? And I think the real problem is with the terminology that they've decided to use, which is the word integration. And so let's look at it, how the concept actually works. Prior to 1966, there was no Canada Pension Plan. So you either received a pension benefit from your employer, and it was a defined benefit pension, or because there really were no defined contribution pension plans at that time, or you lived off your own personal savings, or you received nothing. That was essentially how it worked. But in 1966, what happened was the federal government brought in the Canada Pension Plan. And the Canada Pension Plan is a contributory plan, just like your defined benefit plan is. So this was introduced to kind of level the playing field between people who worked for companies who had defined benefit plans and people who didn't have defined benefit plans. So it was almost like a forced retirement saving for working Canadians. Now, what happened was the government looked at it at the time and said, okay, well, for those people who are, let's say, between ages 60 and 65, there was some duplication because why would you be contributing to two plans at once? So what they did was they adjusted people's contributions who are members of pension plans to how much they contributed to the plan. So really, after 1966, that process that they brought in was called integration. Again, they probably should have used the word accommodation rather than integration, but be that as it may, that's the terminology that we have. So really, so what happens is your pension payouts are factored in based on what you're going to receive on CPP, because your CPP contributions were adjusted because you're part of a defined benefit plan. So how does this look in various scenarios? So let's say you received a pension and you decided you received your early unreduced retirement date is age 60. So that's what, if you took your Canada pension plan at that point, you'll see at age 60, you'll see that you're going to get a reduced pension amount. And we'll talk about that in a bit on the Canada pension plan side. But you see the drop, the bridging part between age 60 and 65, that drop is greater than the amount of CPP that you take, because CPP is reduced at an earlier age than if you take it at age 65. If you take it at age 63, you'll see the drop isn't as great, but there's more of an integrated or an accommodated portion of that when that bridging ends. And if you wait until age 68, you'll see that your CPP amount is larger. So depending on when you take the CPP, it depends on really how much did you get. So let's look at that specifically. We'll kind of go through the CPP itself here. The CPP itself, again, like all other income, unfortunately, it's taxable, and it's also indexed to inflation, just as your defined benefit OPS pension plan is. You can apply to receive the benefit as early as age 60, and the benefit is based on average contribution level while working. So the maximum age 65 monthly benefit that you can receive in Canada right now is just north of $1,253. That being said, most of us on the call today won't get that amount. The reason being is, to qualify that amount, you have to contribute the maximum annual contribution amount for your entire pension for that particular year, or for throughout your career. Most of us didn't earn incomes early in our careers high enough to contribute the maximum amount, so our payments will be a little bit less than $1,253. And to accommodate for some of that, though, the government has introduced to drop out the lowest 8 years of earnings levels. And that's to recognize that some parents will stay at home for a time, and they'll be out of the workforce to either raise children, or they may be building their careers or doing education or what have you. But they do recognize that 8 of your working years is reduced income, and they will adjust your pension accordingly. And your pension is adjusted permanently if you start before or after age 65. Now, by that, we'll get into what those numbers look like as well. As a CPP pensioner, contributions are required on all your income up until age 65. So as long as you're working till age 65, you have to contribute to the plan. Now, from age 65 to 70, if you're still in the workforce, it's up to you whether you want to contribute or not. And if you do contribute to the plan, your pension will increase by 2.5% for each year of contributions on a prorated basis over age 65. Okay, so if we're looking at Canada pension plan, at age 65, we know what the maximum amount is, but what do those numbers look like if we're taking it at an age other than 65? Well, the government has kind of looked at that, and just like all pension plans, like your defined benefit and your defined contribution and the CPP, they take an actuarial number. Now, actuarial adjustment is just a fancy word for basically they take into account using life expectancy data and contributions and growth of the plan, what you should be getting. So if you take the pension plan before age 65 or after age 65, the amount is adjusted and it's adjusted permanently. And it's prorated on a monthly basis. So let's look what those figures look like. If you take your pension before age 65, you will see the adjustment per month prior to age 65 is your pension is reduced by 0.6% per month to a maximum of 36%. So if you take your pension at age 60, your maximum amount that you will receive from the CPP will be reduced by 36%. Now, if you still stay in the workforce and you want to wait for a while to take your pension, after age 65, they will adjust your pension upwards by 0.7% and to a maximum of 42% because you can only delay it to age 70. So if we look at how those figures play out on the right-hand side of the slide, at various ages, that's what your pension will be. So at age 65, as we saw early in an earlier slide, we see that it says $1,253, which is the maximum amount. And you can see if you take it below age 65, depending on which year, it'll be reduced. And above age 65, it'll be increased, depending on each year. Now, your other source of guaranteed income in retirement will be your old age security. Now, the old age security is not a contributory plan, but it is a plan based on residency, and it's a universal plan. So essentially, whether you worked in the workforce or not in Canada, you're entitled to the plan, but there are some restrictions to how much you get. So again, unfortunately, like all income, it's taxable and it's indexed, but it is indexed to inflation. And you can take the plan as early as age 65. You can delay it too as well. And that was only reduced recently, but the earliest you can take the plan is at age 65. And it's based on residency from the age of 18. So as long as you reach the age of majority and you've spent 40 years in Canada, you will get your maximum benefit on your old age security. Now, you have to be living in Canada for at least 10 years to receive it. And it's a prorated amount for 10 years and over. So your maximum benefit right now, and it's adjusted twice a year. Actually, it's adjusted quarterly. And so from January to March 2022, it's $642.25 a month. So as long as you've lived in Canada for the last 40 years, you will get that amount over the age of 18. If you want to defer that amount, it can be deferred and it'll be increased by 0.6% per month to a maximum of 60 months. So you can defer it for 5 years, just like the CPP as well. Now, the one thing is, because of the old age security is a universal pension plan, it's meant to benefit those on lower incomes. So in bringing out the plan, they've introduced what's called a recovery tax, or it's a term, you probably have heard the term clawback. And the clawback is is basically based on 15% of your excess income over $79,054 a year. So for 15 cents of every dollar that you receive in income above $79,054, you will get clawed back, and you will basically give back all of your old age security payments that you receive once your annual income reaches $133,141. So those numbers, as you can see, are fairly high, but certainly they do come into play in a lot of members of the OPS when they do retire. So it's something that has to be taken into consideration when we do financial planning for individuals. So if we look at the guaranteed amounts that a typical OPS retiree is going to be receiving, they'll be receiving their OPS pension, and you can see that. So let's say at age 60, for this individual, they have 25 years of service. Their salary factor is $75,000, and their retirement age, we've done a 30-year retirement, and we've adjusted everything to 2% inflation. We've indicated they have 100% CPP and all AS eligibility. They've started their CPP at age 60. And they've started the OAS at age 65. So what happens is you can see that they qualify for the bridge benefit, the bridge from age 60 to 65, on the Canada Pension Plan. And once that bridge ends at age 65, you can see their OPS pension drops. And the blue bars, which indicate the CPP, remain fairly consistent because that doesn't change. And the old age security pension also increases there as well. So you can see that, really that at this point, the individual isn't at risk for clawback, but this is on their guaranteed income sources. Many pensioners have income sources that are not guaranteed, and these are from their own savings and investments. So let's look at those for a little bit. So what are we looking at here? Well, each, we'll have, people will invest in different things. So we'll look at, looking at low risk investments and low volatility investments. These are things like savings accounts, GICs, term deposits, bonds, and money market funds. So anything that essentially pays interest. These are your low risk and low volatility investments. Unfortunately, they're not, although the volatility is low, the tax efficiency is also low as well. They're not very tax efficient. And 100% of all your income that you receive on these investments are included in taxable income and taxable in the year that you receive them. So if we look at other investments, let's say common stocks or common shares, preferred shares or stocks, real estate, mutual funds. When we say real estate here, we're looking at either capital gains or rental income, mutual funds or exchange traded funds, or that should be ETFs rather than EFTs. Looking at the slide, those are more medium to high growth investments, and they provide potential for higher growth, but they also have higher risk associated with them, right? So looking at that, the income on there could be either capital gains or dividends. On the capital gains side, they're also taxable in the year that they're disposed of, but only half of that capital gain is taxable. So if you receive $1,000 in interest income, that full $1,000 is taxable at your tax rate. If you receive $1,000 in capital gains, only $500 of that is taxable at your tax rate. And finally, let's say you don't dispose of your investments. So let's say common shares, preferred shares, mutual funds, and ETFs. They still have the same growth and volatility profile, but they also pay dividends too as well. And that's taxable in the year it's earned, but they're going to be taxed lower than capital gains because potentially, given where your income level is, and they're subject to a dividend gross up. So, it's a complicated way of declaring dividend income, which I won't get into because it's far beyond the scope of this presentation, but essentially approximately about 66% of your dividends are taxable on average. So, but again, it depends on your overall income. So all of these investments that we talked about earlier are held in different kinds of accounts. For most of us on the call today, most of us will have an RRSP. And RRSPs have are a little bit more complicated, especially for OPS employees than for people who are not part of pension plans. The common thing is with everybody is your contributions are tax deductible, as we all know, and the growth is not taxed. The growth is sheltered within the plan. And also when you take money out of the plan, because sometimes that will happen, people will do withdrawals out of an RSP. It's subject to an automatic withholding tax. So on the first 5,000, it's 10%. Between 5 and 15, it's 20, and anything over 15, it's 30%. And that may not necessarily be the entire amount of tax that you have owing, because because this is also included in your income throughout the year. So if you're at a 25% tax rate and you've only taken $5,000 out of your RSP, you may have to pay another 15% tax on that withdrawal. So it's something to keep in mind. Now for OPS employees, this is where the change comes a little bit here. The annual contribution for any RRSP out there is $29,210 for this year, which is essentially 18% of your previous year's earned income, less any pension adjustment. because you are contributing to a pension plan, that amount is reduced by the amount what's called a pension adjustment. So, and that's essentially to level the playing field between those members who are part of a pension plan and those who aren't part of a pension plan, to have equal opportunities at retirement income. So they don't want to have one party being able to contribute more to an RSP than the other, whether they're part of a pension plan or not. Any unused contribution room carries forward. And this is always, and that amount is always indicated on your notice of assessment from CRA. It's usually at the bottom right-hand corner of your notice of assessment. And when you look at it online, there's actually a link now on my Service Canada site or the CRA site that actually you can go directly to what your unused contribution RSP room is. Now, the other account that we can look at for retirement savings, one that's fairly more recent, RSPs have been around since the 1950s. TFSAs came out in 2009, and these are tax-free savings accounts. Unlike these are registered as well, like RSPs, but unlike RSPs, the contributions are not tax deductible, so you don't get a tax deduction for contributing to them. The growth is sheltered too as well, just like an RSP. But unlike an RSP, and the withdrawals are not taxable. So any withdrawal that you take out of the plan, you will not be taxed on, and you're able to contribute that withdrawn amount in the following year. So you can replace that amount. So it's not a one and done type of contribution thing. And because every year the contribution limit is announced and it's adjusted for inflation. Right now it's $6,000. When the plan originally came out, it was $5,000, and it went to $5,500, and it was 1 year where it was $10,000, and it went back to $6,000. But if you've never set up an RSP contribution, a TFSA account, and you are an adult at age 18 or older in 2009, you could actually roll $81,500 into this account right now. So it is a significant amount of savings that one can use for retirement or for other savings goals as well. The investments that you can have in there are generally RSP eligible savings and investments. So if we looked at that slide earlier on when I showed you all the investments, basically everything on that slide you can hold into an RSP, into a TFSA. The only thing is that you can't hold in these accounts is actual real estate, but you can hold real estate stocks or real estate mutual funds as well. Now, when you're withdrawing money from a savings account, so from a straight savings account, so a straight account, so non-registered account, it's pretty straightforward. They may be wholly taxable, partially taxable, or depending on the investment themselves. From a TFSA, as we said, they're non-taxable, and the contribution amount is added to your contribution limit of the following year. For RSPs, though, the withdrawals are taxable, and the RSPs also have a limited lifespan. Non-registered investments in TFSAs will continue throughout your life. You can only have an RSP up until the year end of your 75th, the year that you turn 71. At that point, you have 3 choices available to you. You can move that to a registered retirement income fund, or a RIF as we all know it. You can actually cash in the account, which in most cases would be the last thing you want to do. Or you can move it into an insurance product called a registered annuity, where you buy a contract from an insurance company, and that insurance company makes a bet with you on your life expectancy and pays you an annual amount based on that as well. So let's look at the example where when somebody rolls their RSP into a RIF. Your amount, the amount that you take out of your account is going to be based on your age, or your spouse's age for that matter. You can determine which age that you want to use, and that actually is a fairly valuable tax planning tool for people in higher income levels. So it's certainly something that one may want to look at as well. You can also, the annual withdrawals are set by formula, but anything over the minimum amount will also be subject to withholding tax, as I showed in the RSP version the 10% to 20% and the 30% as well. So before age 71, the amount that you can take out of your RIF on a minimum payment is fairly straightforward. It's basically 1 over 90 minus your age. So if you're, let's say, age 60, it's 1/30 of of the value of your RIF. And the value is always calculated as of December 31st of the prior year. So if you were taking money out of your RIF this year, the value of the payment would be basically 1/30 of what your RIF was worth on December 31st, 2021. Now, once you convert it to a RIF, the government has set up a set formula. And again, this is based on an actuarial calculation, but these numbers are fixed. So depending on your RIF and your age, that's the amount that you can take out as well. You can see that if you look at the trend, as you get older, the percentage gets larger. And there's a couple reasons for that. Number one, the theory goes that potentially your RIF will be, as you take money out, the RIF will be smaller. So the percentages have to increase to kind of have a consistent payout from your RIF. The second reason is really that you want to, this is not something that you want to keep around as an estate planning tool, because they can be taxed quite heavily upon death if there's a significant amount within the account as well. So really up until age 94, you'll see that they increase fairly significantly. And from 95 on over, it's a fixed 20%. So theoretically, your RIF will never go down to zero if you're taking just the minimum payments. But in most cases, from a financial planning point of view, we tend to not want people to have too much left in their RIFs upon death, especially in the case where there's no surviving spouse. So because the formulas are fairly fixed, the big variable on RIFs is really your rate of return. So if you're looking at let's say $100,000 RIF at age 65, your year-end values, minimum annual payments, are going to be a factor of that rate of return. So if you're only earning 2% on your RIF, you're going to see that RIF, the blue line is the minimum annual payment, and the RIF value is the green field. You'll see that RIF kind of declines quite substantially because as you take money out, and because the growth is somewhat limited, and as we saw, those percentages are significantly higher than 2%, you're going to be eating into the capital quicker. Now, if your rate of return is 4%, you're going to see that is going to decrease not as rapidly as 2%, obviously, but there will be a decrease too there as well. And if your rate of return is 6%, you're going to see that the decrease is, again, not going to be very significant and there will be a larger RIF outstanding at age 95 and beyond. So one of the things that we really look at from a financial planning point of view is the things we can have control over, because there's some things we don't have control over. And certainly one of the things none of us has control over is what the markets are going to do. But what we can do is we can look at how portfolios perform and look at income tax planning as well. Now, there's a term that comes out there all the time, what's called the marginal tax rate. And people say, well, it's taxed at your marginal tax rate. Well, what does that exactly mean? Well, it essentially means your highest applicable tax rate on your taxable income. So it's essentially the money that you earn on the next dollar of income that you receive, be it earned income through employment, be it rental income if you are renting a property, or be it investment income, or even pension income for that matter. And because we're in a graduated tax system in Canada, you will see the tax bands there that I've indicated on the slide, and also indicating the amount of taxes there. So essentially, if you're making on your first $14,398 worth of income, for all Canadians, you don't pay any tax on that. And you'll see as those bands of income increase, there's taxes levied on those specific amounts. So if we're looking at somebody who has a taxable income of $40,000, their marginal tax rate is going to be 20.05%. So essentially on every dollar that they make beyond that $40,000 up till $46,266, they're going to pay 20 cents of taxes on that dollar. If they're making, let's say, $100,000, you'll see that anything up and above $100,000, so on, let's say, $101,000, they're paying 37.91 cents on that dollar above 100,000, up until 103.92, and then it goes up to 43. So how do we keep our income low, taxable income lower? We can look at income splitting or deferral of income. So let's look at a typical household where you have, let's say a pensioner or one member of the household receiving $75,000 in annual income, and the partner of the individual is receiving zero income. So as a household, they're paying essentially $14,859,000 in taxes. And that takes into account essentially all the basic personal exemptions and tax credits and the like. So, but what if we split the income and we say, okay, this is splittable income and it's eligible for splitting. So we report 37.5. The household income is still $75,000, but instead of 14,859 as a household, you're only paying 95.92. So that's quite a significant number lower, and you're essentially saving $5,267 in taxes. So income splitting or income deferral is a good tool. Now you can do that in a couple of ways. Pension income splitting, you can assign up to 50% of any income from your pension to a spouse or common law partner. So a workplace pension, as long as at age 65 or over. And you can, at age 65 or over, you can assign a RIF or registered annuity income. Now you can also do CPP sharing. CPP sharing is basically CPP splitting, where they take CPP of one partner and they combine it with the CPP of the other in the household, and then they average the two out. So that works out significantly well, or especially well as if one person has earned fairly significant more CPP, or is going to receive a larger CPP than the other, and they can average that out as well. And what they do is they adjust your CPP and they pay you out the equal amounts. And you can do this as long as both partners are over the age of 60. For spousal RSPs, that's another useful tool as well, is where you can build up the RSP savings of a partner, and especially if they have a limited income. And they can only contribute so much to a plan. You can open up a spousal RSP for them. The contributor claims a deduction at their marginal tax rate, and the income when it comes out is taxed in the partner's hands, not in the contributor's hands. Now, the only exception to that is withdrawals after 3 years. So if you withdrawing within 3 years of contribution, that's going to be attributed back to the contributor. So you have to be careful about that. Income deferral is something else, and this is something that may comes into play for a lot of members of the OPS, especially if they're looking at a TEI decision. There haven't been very many lately, but in the past 5 years, we all know there have been some significant reductions in the OPS employment through TEI initiatives. So what you can do in this case is you can look at payments other than eligible portions of retiring allowances and transferring those to a RRSP. And these are based on your deduction limit and transferable to a personal or spousal RSP. Again, these kind of get fairly complicated, so it's certainly always good to seek out advice to make sure you're heading in the right direction. Now, the eligible portion of a retiring allowance usually comes from a severance payment, and that's 2,000 per year prior to the year of OPS deployment, prior to 1996. Now, there's not going to be too many of us on the call today that have been around that long, but it can happen. So it's something to consider. Anything above after 1996, it's subject to what your RSP contribution is as well. And you're only allowed to transfer that to a personal RSP as well. You can also ask through a TEI initiative, you can also ask the Ontario Shared Services to defer that lump sum termination payments over 2 years. So they can be applicable. So that way you can kind of share the tax burden over 2 years. They're quite open to doing that, and I've helped many clients through that process as well. So if you, let's say you're getting your pension, and we go back to that example that we used, what if we had a shortfall? And where does that shortfall essentially come from, right? Well, it depends on one's personal situation. And so we have the guaranteed sources of income, but what if they need more than that? Well, that's going to come from your private owned investments. So, but you have to be careful in what you do here, because lots of times people look at a decision, and especially if they're leaving the OPS prior to age 55, they're allowed to either defer their pension, take an early reduced pension, or at some point, or take the commuted value. Now, the commuted value is essentially calculated by, what will replace the pension payments, what amount at retirement would replace the annual pension payments required. But if we looked at an individual who was at age 60 and they had 25 years of service, and they were looking at an income requirement of $56,000 annually, which is not unreasonable, that's 75% of their pre-retirement gross income. They're going to take their CPP at age 60 and OAS at age 65. Essentially, they need north of about, they need over $2 million to really finance their retirement to age 90. So this is something that one needs to look at and be aware of. But the thing is, when one looks at taking the commuted value, and that's, well, the exact figure is $2.3 million, but there's some options available as well. If you take the commuted value, you have to recognize the responsibility for managing your retirement savings, other than the CPP and old age security, is entirely up to you. If you take the pension, you have to remember that 90% of your income is guaranteed. So you're giving up a lot of the guarantee of your pension, a lot of the guarantee of your retirement income, and taking that on itself. Now, again, that is not necessarily a bad thing, but it depends on one's situation. I've had individuals where both partners are employed with the public service, and one has taken the pension and the other one has taken the commuted value. So you have to look at it on a case-by-case basis. And again, when you're in the pension, you're only looking at 10% of the risk. But if you're taking it all, the pensioner is looking, if you're transferring to a LIRA, all of a sudden you're increasing that 10% to a 63% risk. So there's a lot of decisions one needs to look at, and there's a lot of things that one needs to consider before going on retirement. And there's a lot of sources available to you out there. One can look at and from your professional resources, you can look at your OPS benefits advisor. They're very good at helping you kind of navigate through your pension plan. And you can also talk to the pension plans themselves, OPSU Pension Trust or the Ontario Pension Board. I know the OPV has actual advisors on staff there that are very good. And again, because they're not biased as well, they will help you through the planning process. Report Credit Union Wealth Advisor, myself again, and my colleagues, depending all throughout the province, will be more than happy to help you guide to the process, and certainly help you with some decisions along that way. And whether you're looking within the credit union or the public service, or, if you're going to if you're dealing with a third party individual, certainly make sure if they're financial planner, that they are a CFP, because there's a certain code of ethics and continuing education that we all have to participate in. And certainly they'll have the knowledge to help guide you through this process as well. Or if some of you are dealing with accountants and lawyers, your accountant should have some knowledge, and the lawyer may be able to help you out as well. If you're more of a do-it-yourself kind of person, there's some resources here. FP Canada is a great resource, and FSCO, Financial Services Commission in Ontario, has some great planning tools, and the Ontario Securities Commission has some tools as well. If you're looking for an advisor, make sure you go on the national registration search to make sure that they are registered as a licensed advisor. And if you go to the Investor Education Fund, there's some great resources available to you there as well to kind of help you through the process. The Financial Consumer Agency of Canada has some good cross-country options too as well. And Service Canada is a great place to go to get your pension amounts, both from your CPP, how much you'll be potentially getting from that, how much you might get from your old age security, and what your RSP contribution is. And certainly, if you have any additional questions going forward, please contact us at Rapport. We're more than happy to help you. This is what we do 24/7. And this is, all of us are experienced in dealing with members from the OPSs. Basically, our DNA and our heritage comes essentially dealing with members of the public service. So on that, we'll open up the floor to questions and end the formal part of the presentation.
Thank you very much, Michael. So we do have a couple questions. First, we have a question. Where do you find out about your unused portion of your TFSA?
Your unused portion of your TFSA will essentially also be on if you go to the CRA website through Service Canada, there's a link there too as well. That'll be something that you'll be able to have access to. If you don't have a Service Canada site, it's fairly easy to get in. You can either get a password from them or use your online banking access to get through for that as well.
One thing I'd also like to note about that is the CRA only does the accounting for the TFSAs once a year.
That's right.
So if you have already made a contribution for the year, what they show there will not show on your CRA website. So make sure you're accounting for what you did within the year.
Yeah.
Second, can you save real estate money in a TFSA?
Real estate money in regard to rental income? Yeah, absolutely. As long as you have the TFSA contribution room, absolutely, you can put that in there. If you're looking to save to purchase real estate, the TFSA is a good vehicle for that too as well.
I do have one comment. Someone said it's painful to get in the CRA website, and it can be. They do send you a password and you have to wait, but they do now have access through certain online bankings. It won't give you your full picture, but it will give you that RSP room and your TFSA room.
Yeah.
So they've made it a little easier, but I do agree getting the full access can be painful, but it can be actually more painful to try to call them.
Yeah. Very true.
If anyone's ever heard. If I stop contributing to CPP at the age of 59 because of early retirement, should I start collecting CPP as early as possible due to no contribution years between 59 and 65? What is the cutoff age for break even or when to collect CPP? Do you want to answer this, or do you want me to?
Well, we're both going to have the same answer. I think it's going to be, it depends, right? It depends on the individual. There is no rule of thumb. There is no rule of thumb or hard and fast answer. It all depends on what you're trying to achieve. There's been so many articles, and I know Ashton's probably seen them as well, and over the last number of years. When should I take my CPP? And people trying to answer that question. And again, there's really no definitive answer. It depends on what you're trying to achieve. I would always say reach out to us, and we may be able to help you with some more information.
Yeah, one thing to remember too is like it is very personal. So some people hold off on taking their CPP till 65 because even though they're retired, because they have RSP money and they want to take that out at a more before the OAS and CPP kicks in, and then your CPP isn't reduced. It really is dependent on your full situation. So I very much encourage you to talk to a financial advisor. What is the tax rate on RIF after death, spouse, estate? Is it treated as your regular income?
The tax rate on your RIF, well, if you have a surviving spouse, it is non-taxable. It just transfers over to your surviving spouse, partner. If there is no surviving spouse, it's taxed at the highest marginal tax rate. This is why we try to encourage people to kind of reduce that amount and do some estate planning before that happens, because you don't want to have too much in that RIF at time of death.
The indexing of our OPS pension is linked to the rate of inflation, correct? When is the indexed percentage determined?
They usually determine it in January of every year. It's on the rate of inflation up to 8%. So if the rate of inflation goes to 9%, they'll index it at 8%. They'll increase it by 8%, and they'll add that additional 1% to the following year. So it'll eventually catch up. It comes down.
Is the OPS pension based on the best 5 years or the last 5 years of income?
It's essentially based on your best 5 years. And the reason they do that is because they recognize that some people kind of tail off their careers at the end. So they'll either take part-time or they'll take reduced hours and that sort of thing. So they'll basically base it off of that.
So there's a question about fee for our service for OPS employees who are planning on retiring this year. Do you have to become a member of Rapport Credit Union? So we traditionally have had a 1 hour free consultation, and anything beyond that, there is a fee, and that can be discussed with your financial planner, and unless you are a member of Rapport Credit Union and hold assets with us. If you're retired when you are 60 and start CPP at 65, is the 5 years of the 8 years that you take off your calculation, that they take off your calculation because you're paying into it, or do those 8 years come before you're 60?
Those 8 years are take off of your working years. So if you stop working at age 60, they take those lowest 8 years for your employed years. So if you're not working at between age 60 and 65, there's no contribution, so they're not including that.
Okay, so we're getting closer. We still have quite a few questions. Michael, did you want to keep going, or did you want us to, are you good to keep going?
I'm still good to keep going, yeah, absolutely.
Okay.
Yeah.
What happens to unused money in a RIF if there's no surviving spouse?
That's essentially determined by your will. If it gets taxed, unfortunately, and the residue goes to your estate. Now, your estate is either determined by your will
or your beneficiary,
or by your beneficiaries, or your beneficiary. I'm sorry. And if there's no surviving beneficiary, then it's subject to intestate laws in Ontario. So there's a whole complicated way that's determined. So yeah, don't die without a will. I guess that's the best thing.
Can unused RSP room be contributed between 65 and 70? Yes. Yes. In the slide, you indicate CPP drop off the lowest 8 years. What happens if I start collecting CPP before 65? Still 8-year drop off. Yes.
Again,
It's part
It's
of
the
your
same.
working years.
Yeah, it's part of the working years.
Okay. I'm just trying to see if I'm missing any. There's lots of questions asking if we can share the presentation. We will share a PDF version to everyone who registered for it later this week. And then if you do have any other questions, remember to email Wealth or contact your branch and they will be able to help you as well. I think we've answered all the questions.
Excellent.
Perfect. Well, I'd like to thank Michael for his time today, and I thank you all for your participation and those amazing questions. If you do have any further questions, remember to reach out to us, and we'd be happy to help. Have a great afternoon.
Thank you all.